All right, boot campers, welcome to module 3, where we're going to be looking at the Hong Kong dollar peg breaking. This trade has been made famous by Kyle Bass over the last few years with a lot of exposure at Bloomberg, Real Vision, and he's even been working with Congress on some of the bills being passed recently. So it does look like he is tied to the government to some degree in terms of consulting them on the trade talks. Kyle Bass's fund made about $500 million shorting the subprime in 2008. That's what he's really become notable for. And he's identified the Hong Kong dollar as the next big short and has been public about this trade since about 2017. Now, Bass was wrong about the Japanese currency crashing back in 2013. So fair disclaimer in terms of recent predictions. Now, Japan allowed its real estate and stock market to suffer since 1990, protecting their currency stability at all costs. Japan gave up goals to take over the world. Remember, in the 1980s, Japan was unstoppable all the way till 1990. They were talking about Japan becoming a greater economic power than America. Their real estate was just skyrocketing. Everything was going great until it busted. And at the end of the day, they decided to protect their export economy, which means it's critical to keep a stable currency. Now, China's #1 concern appears to be funding the Belt and Road Initiative, jobs for their large population, and expanding their borders. So they're still trying to take over Asia and don't seem to be just trying to protect what they've got and consolidate. So the big question is, what will China defend, knowing that their debt levels are at extreme, that their growth is clearly slowing? My expectation is they will protect jobs and their stock market and allow their real estate market and currency to devalue. The Hong Kong dollar is pegged to the US dollar, but its economy is tied to China. Now, while China is facing inflation and massive debt to GDP problems, it's most likely going to need to keep its rates stable or rise interest rates during a period of time when the US is actually showing normal growth and is in a period of lowering interest rates. So the two economies are going in different directions, and this is essentially tearing Hong Kong straight down the middle. This is a bet that Hong Kong runs low on US dollars, causing a Hong Kong bank run. Right here we have the foreign exchange reserves for Hong Kong. And what's notable is they have printed about 1.4 trillion Hong Kong dollars, and that reserve is protected with 440 billion US dollars. So the exchange rate is at risk if that $430 billion were to become depleted. And so we can see that the current trend in the previous slide in the dotted line is the reserve, while the money supply is going up. So they're headed in opposite directions in the most recent turn of events. Their M2 supply is at 1.47 trillion, but their foreign reserve is only 430 billion. So they have about a 29% reserve, or about 1/3. If we look at this bar chart, we can see once again that they're printing money as their reserves are on the decline. They're short by $1 trillion in summary. And if Hong Kongers start selling stocks, houses, bonds, and also money, the assets to replenish their foreign reserve may dry up rapidly and cause a larger currency run. Now, Hong Kong is owned by China, so you're also betting on China's currency reserve depleting as well. Here's a look at China's M2 growth versus their exchange. Now, this is a little bit misleading because the log scale on one side is completely different than the other. but essentially China could potentially end up dumping Hong Kong and move its financial center to Shanghai. And that's because their $4 trillion reserve has been reduced to $3 trillion. At the same time, they've aggressively grown their M2 supply. So they claim they have about $30 trillion worth of the yuan in dollar terms, but they only have $3 trillion in reserves to back that up. So a lot more leverage in the Chinese money supply relative to its foreign exchange reserves compared to Hong Kong. And in this chart, we can see that their money supply keeps growing at steady pace, currently around 7 to 8% per year, but they're not growing their foreign exchange reserves to match the M2 supply. And so this is problematic for China because no one wants to deal in their currency. In fact, there's very, very little trading volume in their own currency. And so they are strapped to maintain at least a $3 trillion reserve to have ample funds to back up the value of their core currency, and as well to continue importing energy and commodities so they can keep their billion-plus population busy building things. And that's where the big problem lies. So the big question is, what's going to happen to the Hong Kong dollar if both countries or both territories continue to have pressure on capital outflows? And one prediction is that they might just re-peg the Hong Kong dollar to the yuan. And so here's a more close-up chart in the last few years. Leading into the trade war is really when we saw the $4 trillion quickly drop down to $3 trillion at the Chinese bank. And they've been trying to keep that steady, but it's costing them a fortune. And so China has 210 trillion yuan. It claims are worth 30 trillion US dollars, but they don't allow that currency to freely flow out of the country. And so we have essentially the Hong Kong dollar pegged to the US dollar, even though it should be pegged to China. And we have tremendous pressure for China's currency to devalue as money is desperate to get out of the currency. Its foreign reserve is down 25% in 6 years from 2014 high, and again is short by 27 trillion US dollars. Now the big picture is their imports have been slowing down, which we can see ever since 2010. The rapid incline began to slow down by 2015. Really, the party was over. We had a big crash in 2015. This was all on their own. No pressure from the United States. They nearly collapsed their economy from too high of a debt level, from building ghost cities and bridges going to nowhere. Really just a huge waste of capital. And because China is slowing its imports, this is hurting other countries' currencies and GDP. They count on China to be the big buyer. And so we can see their imports and exports have slowed down since 2010, signaling that China is trying to create a soft landing, but there's a risk of a major crash in their economy. And so it slowed import growth because its export growth has flatlined. Here's the two overlaid, and you can see they are directly tied to one another. As the imports have declined, also have their exports. So they're buying less and they're selling less, and this is causing a lot of trouble in emerging markets, especially in their currencies. After having 10% plus growth from 1995 through 2010, we can see that they've no longer been able to keep up this miracle GDP growth. And the formula that they used to have 10% plus growth was essentially just flipping property within their own economy to themselves. First, it would go from the government to the province, then the province to a construction company, and from the construction company, the Bank of China issues massive loans to the populace, and the populace now owns on average, is now purchasing their third home. So these homes aren't even completed. They're just concrete cutouts of houses. They're not leasing them for income. It's just a huge, huge real estate bubble, very similar to what we saw in Japan. And what we have is a massive waste of money from 95 through 2005, which snapped Chinese GDP growth. And so you can see in this chart, their debt has grown exponentially over the last several decades. In 1995, it was around 100% GDP to debt growth. By the 2008 level, it had risen to 150% debt to GDP. And ever since then, it has been skyrocketing up above 250% debt to GDP level. And this is all internal debt. So they simply were printing money at the central bank and then loaning this out to households, to the state, and to private enterprises. And this level of debt is just unsustainable, and it's not paying off. They built a few massive cities that are very vibrant, and they love to show those off. What they don't show off is all the waste of money they've put to use over the last 20 years. Again, building these ghost cities, building airports they don't need, building bridges and tunnels that very few people travel on. They have mega highways that poor Chinese guys are riding their bikes on. 50 million houses that are not being lived in or even finished. A dozen cities the size of New York that were stopped abruptly. And the big picture is they just built far more construction than they really needed for their economy. And so now they're looking for something else to build, and that's the Belt and Road Initiative. And again, their debt has doubled versus GDP over the past 10 years. This is unsustainable. This growth slowdown has had severe consequences on nearly every important currency worldwide. In this chart, we can look at the top traded currencies. United States is by far the most highly traded currency. It trades very frequently against the euro and the Japanese yen. After that, we have the pound, the Australian dollar, the Canadian dollar, the Swiss franc, and then you get to the second largest GDP in the world, China. So why is China's GDP supposedly the second largest in the world, but their currency is the 8th most traded? And most of that trading is just within itself. So the China is converting CNY into Hong Kong dollars. And you can see that huge relationship. 4.3% of currency trades are in CNY and 3.5% are in Hong Kong. So the super rich Chinese like to go to Hong Kong, convert their currency into Hong Kong dollars, turn around and buy whatever they can get their hands on. Recently, it's been diamonds, and then they import that into China. As they all know, that CNY is severely overvalued. After that, we have the New Zealand dollar, the Swedish krona, the South Korean won, the Singapore dollar, the Norwegian krone, the Mexican peso, the Indian rupee, the Russian ruble, the South African rand, the Turkish lira, and the Brazilian real. And we'll see all of these have had tremendous pressure to the downside, which begs the question, why is the Hong Kong dollar different? And it's not. European Union, the euro versus the USD is down 21% over the last 10 years. The Japanese yen is also down 25% in the past decade. The British pound is down 18% in the past decade. And this is all against the dollar. The Australian dollar is down 30%. And again, most of these currencies do have a free exchange rate. So we're able to see with free market forces what the big picture is with the dollar against every other currency. It's only these currencies that are artificially pegged to the dollar that are still remaining flat. Canadian dollar is down 25% against the US dollar. The Swiss franc is flat, and again, they designed this to be a safe haven asset. And actually, it did spike for a short period of time in 2010 when China's economy really had that big crash in GDP growth. Even the Chinese yuan, CNH is down 14% over the last decade. And really, it's in 2010 when they really lost control of their GDP. They tried to strengthen the currency for about 4 years, but that did not last for very long. And we can see the trend now is clearly to the downside. The New Zealand dollar is down 26%. And what do all of these countries have in common? For the most part, they're key trading partners to China. And with China's slowdown, it has also slowed down their economies and put great pressure on their currencies. To offset the slowdown, all of these countries have been on a printing binge and lowering interest rates at a time when the dollar has had relatively firm monetary policy. Now, the South Korean won, one of US's allies, is trading flat. Again, South Korea is a huge export country just like Japan, so it's critical for them to protect their currency value. And one of the few that has traded flat over the past decade against the dollar. Singapore dollar, same setup, tiny little country. And it's, again, one of the few currencies that's held its ground. The Norwegian dollar is down 45%, a massive devaluation, making all of their debts denominated in dollars increase by 100%. So they were paying, say, $1 million a month in interest. Now it's $2 million a month in interest. And the problem is a self-fulfilling cycle. As their currency loses value, they have to print more and more money, exchange it into the dollar, which further weakens their currency and continues to create this divergence in the dollar against all other currencies. The Indian rupee down 36%. The Russian ruble is down 57%. Now, there has been a period of calm over the last several years with Forex volatility at an all-time low, although I suspect this won't last for much longer. The South African rand is down 51% against the dollar. And the Turkish lira is down 67%. The Brazilian real is down 58% against the dollar. So money has been flowing out of Hong Kong for the past decade. We can see in this graph, without one small exception, for tiny little blips, there's been inflows into Hong Kong. The big picture is it's been the outlet for Chinese ultra rich to convert CNY into the Hong Kong dollar and then to get that money out of the country. Money has also aggressively left China in 2018 and 2019, despite very strict capital controls. They absolutely do not let people get the money out of China. Only a handful of select rich are able to do so. And they've been slowly blocking every hole in the boat to avoid more money flowing out. And so we can see in general as well, since 2010, capital has been flowing out of China, not in. Bond yields in Hong Kong have crashed for 2 decades, signaling recession, 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 going from 10% bond yields to 1.6, expanding the bond market substantially over the last 20 years. And GDP growth officially hit negative 3.2% in July of 2019. It's been below 2 since 2010, which makes no sense because China has supposedly been at 6 to 10% growth. And now it's officially gone into negative territory. So if Hong Kong is a leading indicator for China, we can predict that there is substantial downside ahead for China and that their goal of keeping the 6% GDP is not realistic and that they may fall much lower in coming years. Now, another problem for Hong Kong is it's become home to the most expensive real estate on the planet. Here's a little chart of Hong Kong next to Shenzhen and Macau. So again, Hong Kong is supposed to act as New York City, Shenzhen as San Francisco, and Macau as Las Vegas. And they're trying to build the Greater Bay strategy. But some of the square feet in Hong Kong cost upwards of $20,000 a square foot. It's the same story. You have some success. Money flows into the country. They take advantage of that, increase the money supply, issue lots of bonds. This drives real estate prices up. And then the businesses don't want to pay for the expensive labor and real estate, and they get the heck out of Dodge. So real estate prices grew 300% in the past 2 decades. From 2003 was really the low, all the way up to current. Now we are starting to see a little bit of a sell-off in real estate, but wages have only grown by 54%. And so we can see there's been steady increases in wages, but not nearly enough to keep up with the increase of costs in real estate prices. And so 2019 has been marked by protests in Hong Kong. And with no end in sight, the problems continue to get worse and worse by the week. And there's very little risk the Hong Kong dollar will strengthen against the US dollar peg with all of these pressures. So how can we benefit from the Hong Kong dollar if it were to break its peg or even snap? Well, if the Hong Kong dollar were to lose 10% of its value with the trade we're going to overview, we would generate a 11% return on investment. If the Hong Kong dollar were to lose 25% of its value, we would make a 33% return on investment. And if the Hong Kong dollar were to lose 33% of its value, we generate a 49% return on investment. If the Hong Kong dollar lost half of its value, we generate a 100% return. And this bill right here could be the Achilles heel for Hong Kong and for China. Hong Kong Human Rights and Democracy Act of 2019 passed on October 15th at the House, recently signed by Trump. This bill addresses Hong Kong's status under US law and imposes sanctions on those responsible for human rights violations in Hong Kong. Hong Kong is part of China, but it has largely separate legal and economic system. The Department of State shall certify annually to Congress as to whether Hong Kong warrants its unique treatment under various treaties, agreements, and US law. The analysis shall evaluate whether Hong Kong is upholding the rule of law and protecting rights enumerated in various documents, including the agreement between the UK and China regarding Hong Kong's return to China and the Universal Declaration of Human Rights. The bill extends existing annual reporting requirements on matters of US interest in Hong Kong through 2027 and expands such reports to include assessments of 1, limits to Hong Kong's autonomy, either self-imposed or due to China's actions, and 2, whether rescissions of Hong Kong's special treatment would further erode Hong Kong's autonomy. To say the very least, China is not happy with this. The president shall annually report to Congress on Hong Kong's enforcement of US export controls, including items of US origin have been used for mass surveillance in China and whether Hong Kong has been used to evade sanctions on North Korea or Iran. The State Department shall notify Congress if any proposed or enacted law in Hong Kong negatively impacts US interests, including by putting US citizens at risk of rendition to China. The president shall impose property and visa blocking sanctions on foreign persons responsible for gross human rights violations in Hong Kong. So if this really snaps and China just ditches the Hong Kong dollar, the potential for a 90% loss in value would generate a 900% return on investment with this trade. And if Hong Kong dollar were to lose 99% of its value, the potential for this trade is a 9,900% return on investment. That's what makes this so attractive and why there's so many pieces coming out from Kyle Bass. If you can predict a currency losing a tremendous amount of value, it can be highly, highly profitable. And what's interesting about this trade setup is there's such little downside risk with such tremendous upside potential. So can you imagine turning $100,000 into 10 million in a single trade? But the catch is the Hong Kong dollar hasn't budged for the last decade. Will it anytime soon? Here's a look at your Hong Kong dollar. It's lost about 8 cents relative to the dollar over the past decade. The best chance of this trade paying off is likely to be well after 2021 if Trump is reelected and a large-scale trade war persists, which are quite likely both to happen at this point in time. Now, if the US-China trade war escalates before the 2020 election, this trade could profit much, much sooner. And also, if the Federal Reserve increased interest rates or just doesn't cut further, this could also help apply more pressure against their currency and help out this trade. Now, that may not be the outcome of the Federal Reserve because it would come at the cost of our own credit markets being in trouble. On the other hand, aggressive rate cutting and quantitative easing could become a headwind. So it's most likely that if the trade war does escalate, we should expect the Federal Reserve to cut rates and do quantitative easing. But that may not be enough to stop the Hong Kong dollar from cracking. Now, what does this trade cost us to put on? It's a currency bet, so it's not like buying a stock or an option contract, but we do have to pay a swap cost every night we hold the position. That's a cost of 19 cents a day per mini, and each mini represents 10,000 US dollars and requires $1,000 of margin. This means if you had a $100,000 account, you could transfer up to $10,000 into your Forex account. And I would recommend using Ameritrade or Schwab or your normal broker, and you'd be able to risk 100,000 US dollars against the Hong Kong dollar with, again, $10,000 of capital. I would not go more than your total account size as a maximum for people following our program. So with a $100,000 portfolio, if you did move $10,000 into your Forex account, you'd be paying $1.90 a day to hold this position, or $700 a year to hold 10 mini contracts. If conditions in Hong Kong improve and the currency strengthens back to the pre-trade war rates, we'd be losing $1,000 on the exchange rate and $700 to hold the position for a period of a year. So the potential portfolio risk of 1.7% or $1,700 against the potential return for maybe a minimum of 11%. That's a 10-to-1 risk to reward ratio approximately. And those are the kind of numbers that can get you excited. If Hong Kong exchange rate remains flat, you'll only lose 0.7% or $700 per year to hold this trade. Now here's an Ernest Hemingway quote. How did you go bankrupt? 2 ways: gradually, then suddenly. And I pulled this quote because this is not like the trade on China's currency, where it's probably going to devalue for the next several decades as they try to soft land this growth crash. No, this is a trade where they may just change the rules overnight, and those positioned in the trade reap all the benefits, and then the trade is completely over. So they could either let the exchange rate just drop and give up on protecting it. If they did that, they'd quite likely move their financial center to Shanghai. And Jim Rogers, who's a huge China lover, actually thinks that may be what China ends up doing. Or they may just simply repeg the currency to the CNY, their own currency. Either way, the potential is for the dollar to strengthen against the Hong Kong dollar. Look at what's happened with the dollar against all other top currencies. There's only a handful that have even been able to hold their ground, and there are 0 currencies that have gained in value against the dollar. So this may not be a trade you can jump into once it's moving in your direction, like we're planning to do on the CNH trade. We could very well wake up one morning and the Hong Kong versus US conversion rate is simply changed. So tips regarding how to place the trade. Number 1, I would use the same broker your stock portfolio is at so that you can easily transfer funds back and forth as necessary. 2, also, you'll have to transfer funds from your stock account into your Forex account. So at Ameritrade, it's a simple call. Tell them you want to move funds from one account to the other. 2, don't use boutique Forex sites. They may take your money and run. Forex sites are known to try to screw over their clients. So I really would try to use a top tier broker dealer to place this trade. Interactive Brokers is great. TD Ameritrade is great. Schwab is great. And if you are going to use TD Ameritrade, you cannot place the trade from their web platform. You either must use Thinkorswim, or I prefer their trader phone app. So they do have 2 apps, and we'll take a look at the one you would want. Number 3, if you don't want to learn a new phone app or Thinkorswim, then you can just easily call in this trade if you don't want to learn how to place it yourself. This is a trade we're most likely going to put on one time, hold until the exchange rate is changed, and then close it out. This is not a long-term trade that we would be placing over and over again, unlike the trade against China's currency, which will most likely slowly but surely devalue for most likely at least the next decade. Now, for conservative investors, buy no more than 1 mini contract per $10,000 in your total portfolio. You could easily leverage this trade up to be 10 times your account size because they only require $1,000 of margin. But I would not recommend that, and that could set you up for a potential loss of 17% per year, or rather of 7% per year just on the swap fees. Now, if the trade were to go against us and strengthen back to the 2016 level, then you could potentially be at risk of losing 17%. So don't put every penny you have into this trade. At most, I would recommend 1 mini contract per $10,000 in your portfolio. That means you'll have to transfer $1,000 into your Forex account to place one trade. Also, you should be willing to wait a minimum of 12 months for this trade to pay off. I don't want to hear people whining about losing $1.20 a day or $1.90 a day for a few months, as this is a trade that could very well be profitable in 2021 or 2022 if the trade war doesn't escalate in the next 12 months. And even if it does, it's hard to predict when China may actually give up on protecting the Hong Kong US dollar peg. So there's 2 phone apps that Ameritrade offers. One is the Ameritrade app and one is the Trader app. If you do want to place this trade yourself, I would not use Thinkorswim, and I do not support Thinkorswim. It's a great platform, but it's far too complex for how simple our strategy is. The Trader app is beautiful. It's easy to use. We're going to walk through how to do the trade. So once you're approved for Forex in your brokerage account, you're going to want to download the Trader app if you're going to use Ameritrade. The process is going to look exactly the same in all brokers. Search HKD in the search box from your Forex platform, and there's a lot of options that pop up. The only one you want to look at is the USD HKD pair, which I have an arrow at right here. So select that. Now, what we have on the screen now are 3 screenshots from the phone app. So the first screen is on the left, is what will immediately pop up. And this is going to show you the trade button and the chart. So click on the trade button and you'll be moved over to the order editor in the middle screen. Now, here's some of the most important things to look at. We have the ability to buy or sell. In our case, we want to buy the USD against the Hong Kong dollar. Now remember, in the futures market, we'll be doing the opposite. We're going to be selling CNH against the dollar. So the pairs are flipped with CNH compared to, in the futures market, compared to trading the dollar against the Hong Kong dollar in the Forex market. Also in the futures market, we have to choose an expiration date. In the Forex market, we can just set up the trade and forget about it. There's no expiration. Okay, so also we have the ability to flip between a limit order and a market order. I would just do If you want to do a market order, you'll get filled super easily. If you do a limit order, you should get filled quite easily. Just make sure that you're bidding the ask price and not the bid price. So you can see up here is the ask price. When you do choose a limit order, by default, it will automatically fill that in for you. Now, this is a very tight exchange rate with a low spread, so you'll be perfectly fine with a market order or a limit order, as they're very closely traded. Now, the next step will be to hit the confirm button in the top right corner, and that's again after getting the right quantity. So you can see this is 1 mini and represents 10,000. If I wanted to increase the size, I'd hit that plus button. So once you hit confirm, go to send. It's going to review your order. You can see the order is to buy 10,000 USD against the Hong Kong dollar. And in this case, it was a market order at good till cancel. Once you have reviewed your trade, go ahead and hit send at the top right corner. You'll see a pop-up with your order confirmation. And next, you're going to want to make sure it gets filled. So go to the orders tab down below, click the filled button, and you'll be able to see if your trade was filled or not. If for any reason it wasn't filled, you may want to call your broker and find out why. Now, in the bootcamp module email, don't worry, I have all these slides in your email so you can review this and carefully go through the steps at your own pace. And I will do Q&A at the end of the webinar to answer any questions, and I can flip back to these screens. So you'll see it in your filled order box, the price you paid, 7.83037 in this example is the price for the Hong Kong dollar. Now, the next step is to learn how to close this out. So if we do go to the order tab and click on that order, so if I were to actually click on this filled order right here, it will pop up the screen in the middle, which reviews our open position. If we then click on the opposite order, we can easily close out the position. So it pops up the next screen, which you can see sell, or you can also just hit the close position button. Most of these brokers are quite easy to close a position, and really most of your studying should be done on how to open it. But in this case, we click the sell button, and it's going to bring up the order editor. And notice that we're now on the sell tab, and we're selling the 1,000 USD worth of Hong Kong dollar. In this case, we have a limit order, and now we want to do the opposite. Rather than trying to do the asking price, we're going to go for the bid price. And that again is if you're going to do a limit order, you'll be perfectly fine with a market order as well. Now, if the Hong Kong dollar really was devaluing and the price was moving quickly, I would definitely recommend a limit order. When the time comes, rest assured, we will do a live webinar together with all bootcamp members and help everyone get out of the position. Once you hit confirm, you can see the review, sell 1,000 USD against the Hong Kong dollar at market, good till close, hit send, and you're done. Now, once again, go back to the order button, click on your filled tab, and make sure that you did get out of the position. Give it a little time to clear, and you should see that your balance is down to 0, and you can see your profit loss on the trade. Now, just entering and exiting the trade, essentially the spread was about $1.50 entering and exiting the position. And so now I want to review how to do the math behind the trade. So you can see the two items. We were buying the USD against Hong Kong at 7.83037. And then a minute later, I closed it out. So essentially, I purchased at the asking price and I sold at the bid price. And there was a slight change in the value of what we're able to exchange our dollars for Hong Kong dollars. So let's review what this terminology means and essentially how this trade works. So the bottom line is we're actually doing the trade kind of backwards to what would make sense. So we're actually going to be buying the dollar today, and then we're going to be purchasing our Hong Kong dollars in the future. So we're selling our Hong Kong dollars that we don't have yet for the US dollar today. And then in the future, we're going to sell our US dollars to buy Hong Kong dollars. So let's just look at how the math works and how you can calculate your P&L. Now your broker is going to do that for you, but it's good to know how it works. So we open the trade by buying 10,000 US dollars with Hong Kong dollars at an exchange rate of 7.83037 Hong Kong dollars per US dollar. Now remember, we have not purchased our Hong Kong dollars yet. So this is just setting up the sell of the Hong Kong dollars, but we don't know what we're going to pay for our Hong Kong dollars until we close the trade in the future. So the exchange rate today is essentially 0.12770789 US dollars per one Hong Kong dollar. So that's how we're opening the trade. We're agreeing to sell each Hong Kong dollar for about 12.7 cents. So great, that's how we open it up. It puts 10,000 US dollars at risk. When we close the trade, we're going to sell our 10,000 USD to buy our Hong Kong dollars, which again, remember, we've already sold them. We have to buy them in the future to close the trade. And so when I closed out this trade, the exchange rate was 7.8292. So it was a little bit less than it was to open the trade. And again, when I did this, it was a period of a minute. In one trade, I paid the ask. In the exit, I was paid the bid. So the exchange rate to buy the Hong Kong dollars in the future, in this case, was only a minute in the future. But you can see it was a little bit more expensive. So on the first trade, it was 0.12770. And the second trade is 0.12772. So slightly more expensive on the second trade. So the next step is we need to figure out how many Hong Kong dollars did we actually purchase. Well, if we take the $10,000 and we divide it by this number right here, the more expensive one, the second one, we can calculate that we did purchase 78,292 Hong Kong dollars. And now we're going to go sell those Hong Kong dollars for the exchange rate we agreed to. So if we do subtract the two prices, there was a loss per Hong Kong dollar of 0.00001899. And again, if we multiply the 78,000 Hong Kong dollars times the loss, we ended up losing $1.4867. So the broker rounded that up to $1.49, but that's how you do the math. A few risk disclaimers, and then we'll open up this for questions, Donald. Risk associated with Forex trading. Trading foreign currencies can be a challenging and potentially profitable opportunity for investors. However, before deciding to participate in the Forex market, you should carefully consider your investment objectives, level of experience, and risk appetite. Most importantly, do not invest money you cannot afford to lose. There's considerable exposure to risk in any foreign exchange transaction. Any transaction involving currencies involves risks, including but not limited to the potential for changing political or economic conditions that may substantially affect the price or liquidity of a currency. Now that is actually what we're counting on. Investments in foreign exchange speculation may also be susceptible to sharp rises and falls as the relevant market values fluctuate. The leveraged nature of Forex trading means that any market movement will have an equally proportional effect to your deposited funds. Again, that's why I recommend one mini per $10,000 in your total portfolio as a maximum. The Forex broker would allow you to get 10 times leverage, and I do not recommend that. This may work for or against you. Okay, so that's the general risk, is that you can have leverage and that these currencies can move sharply. Now, again, our expectation is that there's very little risk it would strengthen, but there is tremendous risk that it could devalue. All right, so that is an overview. Let me go ahead and unmute this, Donald. What questions do you have for me?
Jason, I tell you, I guess I've never traded currency, so this is all so new to me that I've got to sit down and study what we're doing. But the first trade that you're anticipating would be buying the U.S. dollar against the Hong Kong dollar. Is that correct?
Right. So exactly. So this trade.
Now, is that a Forex trade?
This is a Forex trade. Yep.
Okay.
So this trade, from my perspective, has very low risk in terms of losing money, at least a substantial amount of money, because of the design of the Hong Kong dollar is to simply match the US dollar. So from that perspective, we have limited downside risk unless they were to do something absolutely crazy, like strengthen Chinese currency and then repeg it against their currency. So from that perspective, the real risk I see is a potential to strengthen let me go to this chart right here. So here's a look at the Hong Kong dollar. And you can see the strongest it's been was 7.75. And over the last 3 years, it's devalued slightly, ever so slightly, to 7.83. So our real risk is the swap fee. That's the fee we have to pay the bank to hold this position each day. And that's 19 cents a day per mini contract. Each mini contract represents 10,000 US dollars. And so the basic idea is that we're going to sell Hong Kong dollars for US dollars today, and then we're going to try to buy those Hong Kong dollars in the future for less money than they cost today. Okay. So if Hong Kong dollars get cheaper in the future by placing this trade, we can sell them at their current value, and then we're hoping we can buy them for much less in the future.
And you're anticipating, Jason, this to be a 12, 13 month trade, is that correct?
So Kyle Bass thinks we're going to see results, whether this works within the next year. And the problem with this trade is we can't wait for it to start to work and jump into it. So in the last trade we reviewed, trading the Chinese currency, they're not going to give up on their own currency. I mean, that would be suicide. So China's currency is not going anywhere. It's most likely going to slowly lose value as they open it up and try to spend it. So the more they want to spend that $30 trillion they claim they have, the less value that currency will have. Okay. The Hong Kong dollar is a totally different beast. They might just change the exchange rate overnight. And so it's hard to predict when exactly that might happen. But again, we can see Hong Kong is essentially bankrupt from their bond market, from their real estate market, and from their GDP going into negative territory. So gradually, Hong Kong's been a disaster for 20 years now. But when you go bankrupt, it's in one snap moment. So the Chinese currency, we can wait for the catalyst to officially hit, and we can jump into the trade when it's already moving in our direction. No problem, because their currency is not going anywhere. And that'll probably be something we can play for the better part of a decade. The Hong Kong dollar, if it does get revalued, could change its exchange rate overnight. And then that's that. It will stick to its new exchange rate.
Okay, and so it could be a short-term trade then.
Yeah, exactly. So if Trump raises depending on, so the catalyst I see breaking the bank in Hong Kong, continued protests. So we've had six months of protests now, and it's getting worse and worse.
Right.
GDP's gone into negative territory. China's running out of money. The trade deal's on the verge of breaking down. And now we're passing legislation in the United States that is putting risk on Hong Kong as a money center for China. So I think the timing is great to enter the trade. Predicting when it may snap is probably more difficult. You know, if you could predict what Trump's going to do, you might have a better idea of the timing. But yeah, I think this is a trade that has very low risk for us to put on at this point, but it has tremendous upside potential. And let me pull up. So, you know, if they did something like just revalue it against CNH, you know, the overnight effect of that might just be a little bit of a deval. So if they just devalued it by 11%, or 10%, we pick up 11% return. So that's not a bad return. So if we had our whole portfolio in this trade by having 10 minis per $100,000, we might lose over the course of a year 1.7% if we're wrong. If this just trades back down to its 2016 levels, then we might lose 1.7%. If it just trades flat from here, we're going to be risking $700 a year. But if they allow it to slip just 10%, and what I do want to look at one more time, let's look at how every freely traded currency has performed one more time, just to get a feel for what the overall currency markets have been doing. So the euro is down 21% in a decade. Hong Kong dollar is not. Japanese yen down 25%. Hong Kong dollar is not. British pound is down 18%. Hong Kong dollar is not. Australian dollar is down 30%. Canadian dollar is down 25%. The Swiss franc is flat. It's a peg against the dollar. It's supposed to be the safe haven currency. The Chinese yuan is down 14%. So that's probably, if they were to simply repeg the Hong Kong dollar against CNH, maybe that's the sort of devaluation we might see instantly in the trade. And that's not a bad return. If that were to occur, we generate a total portfolio profit of maybe 16% overnight. That's the potential profit if they were just to repeg it to their own currency. But what makes the trade really exciting is if it were to devalue by a greater degree. And so we've seen with free markets, every currency in the world almost has devalued by at least 14% or more, some of them 20, 50%. And so that's when the trade really gets exciting, because of the low risk for it to strengthen, and the profits grow exponentially the bigger the devaluation. So 25% devaluation is a 33% return. But if we get more of a 33 or 50% devaluation, now our entire portfolio can grow substantially. So 50% total portfolio gain if we have 10 mini contracts per $100,000 in our portfolio. Even if you only had one mini contract per $10,000 in your portfolio, and we had a 33% devaluation, your total portfolio could appreciate by 5% from this trade. Now, this has only happened a few times in history where currency pegs have gone to almost zero, but it has happened several times. In fact, most currency pegs end up breaking, and they do end up losing almost all their value. So if that were to happen, then the potential profits are phenomenal. Now, I'm not saying this is most likely.
Yeah, the probability is not very high there.
But it's possible, and it has happened in the past. So yeah, the risk to reward on this trade is just too good to turn down. And it ties into our big theme that China's slowing down, and we have two mega countries fighting over supremacy. So the big catalyst for this will be the trade talks breaking down and escalating. That could be what really makes this trade go our favor.
Okay, so probably the first trade we would be doing is the U.S. dollar against the Hong Kong dollar.
Yeah, so here's how you look at the trade again. You're going to want to do the USD Hong Kong pair.
Uh-huh.
And so we're buying the dollar against the Hong Kong dollar today. So
Right.
that basically means we're selling Hong Kong dollars to buy US dollars at today's exchange rate. And that's what's funny about it's the same thing with the futures market. But we don't own any Hong Kong dollars right now, right? So in the future,
Right.
we're going to buy our Hong Kong dollars. And so the bet is simple as this. We're going to sell them at today's rate, which we think is overpriced. We think Hong Kong dollars are not worth, we don't think 7.8 Hong Kong dollars is worth $1. We think it's worth much less. So we're betting that if we buy dollars today by selling Hong Kong dollars, in the future, we'll be able to buy those same Hong Kong dollars for much less money.
Okay.
So you're going to buy the USD Hong Kong pair,
Right.
and then in the future, we're going to sell the US dollar for our Hong Kong dollars we're purchasing in the future.
Okay.
And so
Now, a mini then is how many dollars? Hong Kong dollars?
one mini represents 10,000 US dollars, and your
US
broker
dollars.
require $1,000 of margin per mini contract.
Okay. So in other words, if I place an order for 5 minis, I'm basically I'm putting up $5,000.
Correct, of margin
Okay.
in your account.
Right.
But that represents 50,000 US dollars of currency.
Correct. And that's going to cost about $700 per mini contract per year to hold.
Per 10.
Per 10. Okay. Okay.
So if you wanted to only have one of these positions open, it would cost you $70 a year or 19 cents a day.
Okay.
Now, if it continues just to slowly slip, that's really not the most likely outcome. By the rule set for the Hong Kong dollar, it's supposed to track the USD 1-to-1. So, so they're not trying to strengthen or weaken it. They really want this to be a stable currency that can be freely exchanged. There's no capital controls on the Hong Kong dollar. So it's really China's weak spot. They can't control that Hong Kong dollar like they can their own currency. So the expectation is if they were to stop allowing the Hong Kong dollar to freely convert, then that would create a panic, and essentially they just run out of cash and they'd have to shut down the Hong Kong dollar in some shape or form. They'd have to stop the outflows.
And that's when they probably would repeg to the CNH.
So yeah, so they might repeg it to CNH. Now, if they did that, we'd be trading it in tandem with the CNH trade. So we might be able to hold this position for much longer because we think CNH will also devalue over time. So yeah, so there's really two really potential outcomes, maybe three. Maybe one, they just start to devalue it. They say we're not going to match the dollar 1-to-1 anymore, which would be a nightmare. That would cause everyone who holds Hong Kong dollars to sell as fast as they can.
Sure.
Now, if they were to repeg it to CNH, potentially a huge capital outflow and a lot of pressure on China. Now they're going to have to essentially buy all these Hong Kong dollars. So no matter how you skin the cat here, Hong Kong's got some tremendous problems. And if the U.S. continues to apply pressure, I mean, they had problems before the U.S. was applying pressure, but now with all these different legislations that may make it not a financial center. So if we start blocking capital to Hong Kong because of part of this trade deal, that would be another nightmare. So one of the best investors of all time, Jim Rogers, who's an absolute expert at this topic, he's the first to gloat about how great China is. He moved his family to Singapore. used to work with George Soros. I think he broke paths with George Soros because he didn't like his ethics. And they're actually famous for breaking the pound. He made a ton of money betting against the pound, one of the famous currency trades. But he actually thinks China may just give up on Hong Kong if more and more pressure continues to mount. And so he thinks they might just move their financial center to Shanghai. Now,
Yeah, I listened to that. I listened to that interview, and that's the first time I've ever heard that. But that was interesting.
Yeah. Now the problem with Shanghai is that there's no rule of law. So there's no getting your money out. There's capital controls. So it's back to this kind of inbred financial system that China has. That's why they need Hong Kong, but it's costing them a fortune. So they've got $430 billion in reserve, and they have 1.4 trillion Hong Kong worth of dollars in circulation. So as their GDP is negative, as these assets start to lose value, there's a concern. The big concern is a bank run, or China stops supporting Hong Kong.
Well, it looks to me like, like I said earlier, I'm so new to this currency thing. I've never done any currencies. And I used to think that United States, the dollar, was like a house of cards, but Jesus Christ, it's like a castle compared to some of these others, isn't it?
Yeah, well, the big picture is all these other currencies are so untrustworthy.
Right.
It all gets back to the rule of law. Okay, so if you don't have a strong rule of law, then there's corruption. And when you have corruption, they end up getting their hands on the money printing press. And so all these countries have gone wild printing money and issuing debt. So they've been issuing a lot of debt, but they're not issuing it in their local currency. Only a few countries have issued much debt in their local currency. And really, it's just China. Is probably the only, China and Russia are probably the only two countries who have not taken public debt. And it's not because they don't want public debt. It's because no one trusts them because they have no rule of law. It's a total rule by authoritarian power where one dictator wipes out everyone else and they change all the rules. They take the wealth away from all their competitors. So because of that, you'll see that the Russians and the Chinese don't have a large public debt. But every other country in the world, they can't issue bonds in their own currency. No one wants to buy that. They all want to get paid back in the reserve currency. So it's become a self-fulfilling problem. And I don't see how they get out of it. So if you have debt in dollars, you have to convert your currency because your economy is not collecting dollars. It's collecting revenue based on its own currency. They have to exchange that currency into US dollars. So yeah, the US would have to go on a massive debt spree, which it is, cut rates to zero, to even put a budge in this big picture problem. So yeah, Jim Rogers thinks the dollar's going significantly higher and that we're going to have a currency crisis. And he's no fan of the US at all.
No.
So to see him say that, at least. But yeah, you look at the big picture, 17 out of 20 global currencies have lost anywhere from 15 to 60% of their value, but the Hong Kong dollar hasn't. You got to ask why. Is Hong Kong just kicking ass? No, they're not. They're at negative GDP growth, and their bond yield has crashed for 20 years, signaling low growth, and in fact, the opposite of growth. So they're stuck with the most expensive real estate in the world, and during a period where we have the greatest power in the world targeting Hong Kong. And if you think those protests are not being pushed on by US, well, I doubt that. So I think that the Hong Kong drama is part of this trade war, and that most likely we'll see these problems continue to escalate. So yeah, it's a neat setup. We may just sit on this for a long time and see nothing, and then one day we wake up and well, I think what we'll see is just the problems get worse and worse and worse in Hong Kong, and we're going to wonder how much pain can Hong Kong and China take before something snaps. And if this were to snap, it would create a domino effect with other currencies. So we've already probably missed the big move in most of these other currencies. So that's why this is such an attractive trade. You're counting on China's growth slowing down and this odd setup they have where China has a closed account, Hong Kong has an open account, China's economy is slowing, but the US economy is pretty much just flat. So there's this huge tear between the big forces. And so really the Hong Kong dollar should be pegged to China, if anything, and not to the US dollar. So if they were to strengthen it, it would cost them a fortune. You know, so I don't think they're going to strengthen it. And that would almost be an act of war for Hong Kong to go and start strengthening itself against the dollar.
Yeah.
So it's one of those trades where it might just be awful boring for a long time, and then something changes and we can close a profit on it. Now, if they really repeg it to CNH, this might be a more long-term trade. But if they simply abandon it, we might see a huge devaluation, and then it finds a fair value, and then we get out.
Well, like I say, the risk reward looks pretty good.
Yeah, it's not often you can find a setup like this. Now, shorting CNH is different. We might get faster, immediate gratification from that trade, but it only represents, you know, let me go back to this slide. You got to ask yourself, why is the second biggest economy in the world that's supposed to overtake America the 8th most traded currency?
Yeah.
Doesn't make sense. It has 1/20th. So they claim to have $13 trillion economy against our $22 trillion economy. So a little over half. But yet they only have 1/20th of the currency trading. And most of that, 90% of that trading is with their own country. They're trading, it's just the rich trying to get out of CNY to buy the Hong Kong dollar, which they then turn around and buy anything expensive that they can import back into China.
Right.
It's a joke. Their currency is a real joke. And that's the big picture. Now, CNY, because it's controlled, they can easily make that trade create a loss in our portfolio if they wanted to for a short period of time. And so it makes that trade more difficult. So when we short CNY, it'll really be CNH. CNH is the offshore yuan. CNY is the onshore.
Okay.
So we're going to wait for the catalyst and the momentum to enter that trade. And we'll probably have immediate gratification on that trade. We'll still have to be patient and wait for great timing. The Hong Kong dollar, you don't have that opportunity. By the time the catalyst hits, the trade's quite likely over.
It's probably gone, yeah.
So different setup. And that's why, that's why Kyle Bass isn't out trying to tell everybody to short the renminbi. He's out telling everybody to short the Hong Kong dollar. Another thing is we got a lot of people pushing this fear on the Hong Kong dollar. So as their property starts to lose value, the most expensive real estate in the world is in Hong Kong. And so all the people who've bought at the top, as they start to see the growth slow down, they see more and more sanctions from the United States. I think that the pressure is going to be to sell Hong Kong assets. And it's the same story we saw in Japan. So they went sky high for a long time until they drove those real estate. That's really the way to bankrupt a country, is to allow your real estate prices to get too high too fast, because it makes everything just too expensive to continue.
Right.
You get a selling effect that reinforces itself.
Well, I tell you, Jason, it's really interesting. Like I say, I've never delved into currencies. It's a totally different game than what I'm used to, but I can see the potential in it.
Yeah, so China has the currency trading volume of a third world country. Look at that.
Yeah. Isn't that something?
Yeah. So they've greatly overvalued their currency. My bet is that they're going to protect the job market because they have 1 billion people and they want to protect their border. So I think their biggest interest is trying to protect Hong Kong, trying to take over the government in Taiwan, and work their way around with the Belt and Road and just try to expand their territory. And so they need to make their currency convertible so that they can purchase steel, oil, energy. They can pay their 1 billion people in the local currency, so that's fine. What they can't do is import all the stuff they need from Brazil and Argentina and all their core trading partners in their currency. No one's going to do it. The only way they would do it is if they allowed the currency to be freely traded. If they allow the currency to be freely traded, it's going to lose a lot of value. So I think they're going to let that bubble slowly devalue and try to open up the currency so they have more money to spend. And that's going to come at the cost of probably their real estate market coming down and most likely the value of their currency coming down. But that'll allow them to strengthen their stock market and be able to start attracting outside capital so that they can continue to keep all these people busy. Because what happens if you got 1 billion people without a job? You get a revolution. And that's their biggest concern, is they have a monopoly on essentially this 1 billion person slave labor that they tax at 70%. So they lose that, and there goes everything old President Xi has been working on.
Right. Well, it was surprising. One of those recordings I was listening to, all of these people in China living in caves. I've never even heard of that.
Yeah, well, it's because first they built the Great Wall, and the next thing they built was the Great Firewall, which their internet is completely closed off. So it's very hard to get information of what's really going on in there. It's crazy. It's absolutely crazy what's going on in China.
Right. Well, and I think the rest of the world is quickly learning you can't trust them. I mean, at least the U.S. can't trust them because, they've never lived up to anything they've ever, any kind of, all these agreements they're talking about trying to make. They got to know that China's not going to live up to it. It's like the other day when they said they were going to buy $50 billion worth of agricultural products, and then they didn't buy a dollar's worth. So, yeah. I mean, what good are these agreements when an agreement's only as good as the two parties that make it?
Well, see, I think their culture is that you're weak if you don't know how to lie, cheat, and steal.
I guess
say that in a disrespectful way, but that's just, you go back, if you have a civilization for several thousand years, they've lived through so many different periods of time.
Oh, yeah.
It's not nice. So if you're just going to be, completely open and open book, that they look at that as weak. They look at America as weak, and they think they can take advantage and become the number one power in the world. And they have been the number one power in the world most of history.
Yes, they have.
They think this is 100 years of bad luck, and now that this is their time to take the lead. So most likely they're not going to budge 1 inch on anything, and they're just going to take the punches as best as they can, give it back as best as they can, and try to take over Asia. So I think that's what they're aiming to do. And if it means losing United States as a client, they believe that'll hurt United States more than it hurts them, and that with our political structure, we can't pull it off. So it looks like
Yeah.
they're just going to keep dragging their feet here until Trump loses his cool.
Yeah.
So whether he loses his cool in a week or in a year, there's very little chance that China's going to buy $50 billion of ag purchases. And think about it, the people they buy their agriculture from, they're able to essentially get commodities from. So rather than paying, that's a good way for them to get other imports and to create trade relationships. So we're basically asking them to ruin relationships. As far as they're concerned, America is nothing but a payday to get a surplus of dollars that they can go spend.
Right.
Buy all these commodities. So it's not in their interest to hurt all their other trading partners to benefit the United States.
No, they're not going to do anything to benefit the United States.
Yeah, they're good at hollowing out our manufacturing sector and stealing all our stuff. So America's slowly waking up.
Well, thank goodness. Thank goodness. Well, this is interesting. I mean, it's really interesting, and it looks like there can be some money made at it. Just the short term I've been looking at it and what I've been listening to and reading, they just can't help but keep going down. I mean, there's no way they can stop it from falling.
Well, so Japan had the same problem, and they chose to allow the real estate and the stock market to crash, and they ended up printing a ton of money and using every penny they had to protect the exchange rate of the yen. And the yen could see trouble ahead. I mean, their debt to GDP is the worst in the world. And so, Kyle's trade in 2013, betting down on that, still might pay off. I mean, it's down 25% over the last decade. So I think he missed the first move because most of that move did happen from 2010 through 2013 is when most of these currencies really dropped the most. And that's right when China's GDP collapsed from 16 down to 5, jumped up to 10. But I think the next big slowdown is ahead of us. And so we want to look at which currencies have not budged yet and potentially have the biggest moves ahead. And that's clearly China's currency and the Hong Kong dollar. The Swiss franc is not really at risk from what I can see. It's such a tiny country. They're just a money center. Very strict central bank policy, good law. So probably not a big move on that. Canada's in a big heap of trouble. And again, it's the Chinese came over there and Australia. Their real estate's at record highs, same problem. So they've got some tremendous problems ahead. Some other people are trying to look at this trade and figure out some knock-on effects. So a lot of people are wanting to bet the Canadians haven't cut rates as much as other countries. So there's some bets out there that the Canadian interest rates will go down. So you can take this trade and try to predict the domino effect down the road. But we don't need to be so fancy. The bottom line is the Hong Kong dollar and CNY are under tremendous pressure. They haven't really devalued yet, and they need to over the course of time. And so those two we can laser target our efforts on and do really well. Now, maybe you make a little more betting Canada's housing crisis and Australia's housing crisis is going to snap. And those could be some other potential trades. But for our folks, for now, we're going to be laser focused on being an expert at I like to become an expert at China and then the central bank policy. That's really the two expertise we're following right now. And from that, you can figure out a lot of things that will occur. But all the other currencies are already down 25 to 50%. And China's barely budged, and the Hong Kong dollar hasn't budged at all. So from a risk to reward ratio and being able to target our attention and our time, this plays in perfectly to our emerging markets Tuesday trade. So it's not really increasing how much we need to follow in terms of news, but it's playing into the big picture very, very well. So as far as timing, when I'll officially launch the trade alert, I'm still not telling everybody to rush into this trade just yet. not that you have a lot to lose, but I would like to see the trade talks not come to a conclusion on this week, and to at least be delayed into January. So quite likely Friday, we're going to put on another VIX call option expiring in May, probably at the 35 strike, one contract per 100 shares of SPY. And then maybe next Friday, we'll be able to enter this Forex trade. And then we'll wait for the real catalyst of the trade talks breaking down to put on our futures contract. And we'll most likely do the front month on the futures trade for a quick profit on that one until we get more clarity as to whether trade deal is going to be a long-term problem or if they're just kind of still a cat fight at this point. So we probably won't go for that 13-month future contract. On the first trade, we'll probably do a 1-month future contract.
Just to get our feet wet.
So that's our timing. Friday, expect a call option on the VIX. Next Friday, I'll be willing to at least put up part of the Forex trade against the Hong Kong dollar. And then the second we get tariffs are on, we'll jump into the front month on the CNH trade in the futures market. And that again will be for a quick profit. And again, betting down on China's currency is probably something we'll be doing for the next 10 years. As it's a slow motion train wreck. It's not something they're going to allow to, if they allowed it to devalue too quickly, it could really cause havoc for China. So I think they'll slowly but surely try to let the air out of the currency bubble in China.
What strike did you say that you're contemplating on the VIX on Friday on the phone?
35 again.
35.
But it'll be the May expiration instead of April.
Okay. The reason I'm asking, I'm going to be on the road Thursday and Friday, so I'm not going to have as much freedom to do as I need to. I'm just going to have to work it in when I can. So, I'll keep checking, make sure that you did put it on, and then I'll try to get it made during the day.
Okay, great. And yeah, don't pull the trigger on that one yet. We may actually wait till Monday on Friday. We'll see. Because if they do delay the tariffs, we'll probably get the VIX to collapse even lower, and then we'd want to jump on that. Now, if they tell us officially tariffs are being delayed by this week, which we got a hint of today from the Wall Street Journal, then the VIX may come back down. I'd like to get into it below 14. Right now, I think it's at 1550.
Right.
Kind of high considering we haven't had any volatility yet. So that does show the trade's going in our favor. So the trade's looking very good on the VIX. Yeah, so wait till Friday to see what I say about that trade.
Okay. All right. Well, that's good. Let me ask you a question.
Well,
am I the only one on?
Yeah, a lot of people told me they're going to have to catch this one on the replay.
Let me ask you, how many? And I could ask Dean, but how many do you have on the boot camp program now?
We have about 150 total clients and 15 who are in the boot camp. Okay,
good. So you're getting some interest in the boot camp program. That's good.
Oh yeah, it's a lot of fun. It's basically like having a huge essay due every 2 weeks. So I'm having a blast. No, I love this stuff. So obviously it's not work for me, but yeah,
you live and breathe it, don't you, Jesse?
Boot camp built, and then we can replay this over and over again. We'll definitely update it every time we cycle through it, and it'll be exciting to see how the content kind of evolves as really the politics evolve. I think it's going to be the big change of the next 10 years. It'd probably be the politics are going to get kind of ugly as the poor want to strip the money away from the rich. I think that's going to be a big trend that we're going to watch. And so, you can go back to Japan when they had that big slowdown. Guess what they had? Wealth tax. Who's talking about wealth tax?
Yeah, that's right.
All the Democrats. Their wealth tax was no 2%.
No.
Their wealth tax was somewhere between 50 to 70% of everything over $10 million in all bank accounts overnight. Imagine that happened in any country.
Well, I don't see how you avoid an uprising.
Yeah, so that's probably the general theme over the next decade is the wealthy have become super wealthy from stocks and real estate going up, whereas all the labor, their costs have gone up tremendously, but their income has stayed flat. And so that can't last for too long. So that's when you get
No.
revolutions, you get takeovers in the government, you get all kinds of crazy shit. So
Right.
we got some exciting times ahead. Plus, the only thing keeping this together over the last 4 decades has been the Fed being able to make money cheaper. And now we're getting to the end of that rope.
I was going to say that's about gone too.
So they might be able to bobble it between 0 and 2 for another few years. But eventually you get back to exactly what we saw with all the social programs after World War II. You know, they're handing out money like it's candy and spending it like it's, like it grows on trees. And eventually you get inflation. So
Yeah. Sooner or later, you got to pay the piper. Is what you're going to do.
exactly.
Yeah. Now, are we planning a get together in your city in March? Did I hear that correctly?
We're going to do it after we complete the whole series. So I think that'll be closer to summertime.
Okay.
So I'll get the official dates for everyone. And there's a small chance we might not do an Albuquerque. We might go to a fun stock investing conference in Florida or New York or Vegas and have a nice conference room rented out so that people have some other content to enjoy too. So we'll pick the exact, but my goal is to get our group together at least once a year in person. So we get to meet each other, have some special presentations.
Yeah, that'd be really good.
Yeah, exactly. So, most of the content's more effectively taught through this medium. But yeah, I do want to get our whole group together at least once a year. It can be in Albuquerque or potentially maybe in Las Vegas, Florida, or New York is where they have some really good conferences, which would be fun to attend.
Yeah.
And I'd also be able to potentially grab some, high profile names to come in and give us some exclusive content as well.
Okay. Super. Okay, well that's about all I got for today.
All right. Well, hey, thanks for showing up live. Appreciate it. And I'll see you tomorrow morning. All right.
Yeah, thank you. I appreciate it.
Okay, thanks.
Hey, now you're gonna send this out.
Yeah, and most importantly, it's going to have these step-by-step instructions printed out.
Yeah.
So that you can easily follow along and make sure you get the trade right. So
I broker with a company called Allen, which it used to be Trade King over in Charlotte, and they don't do Forex or futures. They sub it out to one of these boutique things,
oh well, then just do it all at Interactive Brokers then.
Yeah, that's what I'm gonna do is just do it all at
And I would just call in. These orders are so simple and so infrequent. I would just call them in.
Yeah, that's what I plan on doing is just call them and say, hey, I'm not going to make that many of these things and make it for me.
Yeah, I don't think they have a service cost to call it in. Even if they did, who cares? It'd be like $5. And that way you can make sure you get it right. And and it'd be a lot easier that way. So if I were you, I'd just use Interactive Brokers for both these trades.
Yeah, that's what I was planning on doing. But the boutique things, they don't. I mean, you don't have. Ally has no control over them at all. I mean, they're just basically funneling business to them.
Yeah. So the futures market all runs through the CME. So it's like a real network where all the brokers connect to one legit settling infrastructure. Forex is not like that. Forex is like a whole bunch of little marketplaces all over the place.
Right.
So people make money just trying to arbitrage from one market to the other.
Sure.
And so the Forex industry is known for being super corrupt. It's a joke. So I definitely try to keep a top tier broker for all Forex trading.
Yeah. Well,
Luckily, Hong
interactive,
Kong
I
pair
guess,
is the main
yeah,
pair.
interactive is probably as good as you're going to get, I guess. I don't particularly like, I used to do business with them. I don't particularly like them, but there's not much you can't trade with them.
Interactive brokers?
Yeah.
Yeah. They have the biggest selection of all brokers, bar none.
Yeah, they do.
And that's how they attract a lot of these advanced hedge funds, because they have low fees and they can trade all the exotic instruments you could dream of.
Right. And they're not really for the little guy like me, but we'll use them when we need to.
They're a pain in the ass, yeah, as far as how they how the platform, their software platform is crazy looking. I didn't even try to learn that one. Thinkorswim I like, but I even think that's way too complex for what any of our members need.
Yeah, that's with me.
The phone apps are beautiful for Ameritrade.
Are they?
So I love those phone apps.
I did Thinkorswim. I did interactive. The problem I had was, hell, they didn't have anybody who knew how to do it themselves, much less teach a client how to do it. I just got totally frustrated with them.
Yeah, it's like you're flying a F-16 fighter jet or something when you load that up, and all we're trying to do is sell a call and buy a put. So we don't need so much complex options for that. Now, when I was
okay, well, I got to run.
All right, Don. Sounds good. I'll see you tomorrow on the webinar. All right.
Thanks, Jason. Appreciate your time.
Thank you.
You bet. Bye bye.